Hi guys, welcome back. In this video, we will solve a past paper question from October-November 2022, paper 22, which says discuss whether expansionary monetary policy will be successful in correcting deflation. Now, before I solve this question, there are two things that I want to clear out in the first go. First, this is a past paper solution video. It is not me explaining the entire concept. So it is assumed that if you're watching this video right now, you're pretty much aware of the subject content. Second, remember that A-level examiners mark your answers based on how successfully you have fulfilled all the assessment objectives. Each assessment objective has separate marks, and I have already made two detailed videos on the marking pattern of the examiners and also on a separate video on assessment objectives. And you can check both those videos out in the playlist named All I Need to Know. It is recommended that you watch those two videos first and then come back on this video. Now guys, for this particular question, we have a problem given which is deflation, and then we also have a policy that is given in the question which is expansionary monetary policy. And this question is asking us to evaluate its effectiveness and to what extent will it be successful. Since the question says discuss whether an expansionary policy will be successful. Now remember that whenever we are given a problem in the question, that problem could be anything. For example, in our case, it's deflation, but it could be falling growth, it could be inflation, it could be, maybe a current account deficit. So whenever we are given a problem, right, and the question at the same time proposes a policy as well, and then it asks us to evaluate the extent of its effectiveness, then the following steps should be followed that I have written and that you can see on your screens right now. These steps basically, which is basically the structure of the answer. You should start off by defining the policy. In our case, it is expansionary monetary policy. Write a few lines on it and when, and also explain when is it usually implemented. Then define the problem, which is deflation in our case. Write a few lines on it. If possible, also show the problem, that is deflation, through a diagram. Then the next step is that you analyze the effectiveness of expansionary monetary policy in curing deflation through diagrams. You are not supposed to just draw the diagrams, you are supposed to draw them properly and at the same time explain what you have drawn. And then comes the part where we analyze, once you have explained or analyzed how expansionary monetary policy will be successful in correcting deflation, then comes the part where we analyze the limitations or hurdles or loopholes of the policy, that is expansionary monetary policy, in curing deflation. Remember that when we have discussed questions, we need to critique the limitations, we need to critique the assertions, basically we need to critique the narrative. And right now, what we can decipher is, or the narrative is, or the assertion is simple, that yes, expansionary monetary policy is successful. I mean, we know it is successful, but not always, right? There are certain factors that could make it unsuccessful. But at times, it's not about just being unsuccessful. It's also about the fact that it may not be as successful as it was thought out to be. So these are known as basically limitations, or you could say hurdles or loopholes. So all of those limitations, loopholes or hurdles of the policy that could, hinder the effectiveness or reduce the effectiveness of the policy in curing deflation needs to be mentioned and explained via diagrams. Then comes our evaluation, right, where we talk about that the effectiveness of the policy would basically depend upon this and this and this and this factors and these factors. That is, how successful would this policy be, or how successful would expansionary policy be in curing deflation would depend upon these and these factors, which we'll discuss in the video as well. In the end, we will conclude our answer with a conclusion paragraph. Here in the conclusion paragraph, it is also encouraged that you write you also mention an alternate policy that could be used alongside expansionary monetary policy to tackle deflation. And whenever you are given a policy question and there's a policy that is mentioned in the question itself, also suggest alternate policy, that is, maybe if this policy is not successful, then maybe another policy could be a better option, or maybe another policy that could be used parallel to this policy to sort of corroborate our policy that is already mentioned in the question, right? For example, the use of fiscal policies or supply side policies in our case could be used to complement and corroborate and expansionary monetary policy in correcting deflation. Now, guys, also remember that in order to score the maximum marks possible, students must ensure that all the points that I have mentioned in the structure are elaborated in a way. Remember this and focus to what I'm saying right now, that they are all elaborated in a way that depicts the student's economic art of writing with good use of economic vocabulary and a clear depiction of subject knowledge. Remember that. Students must not appear vague and they must not appear contradictory in their explanations. Okay, so now let's move on with the question. So you will start off your answer by basically defining what monetary policy is. And you will say that monetary policy refers to the actions and the strategies that are implemented by a country's central bank in order to, regulate the money supply and the interest rates in the economy. And the primary objective of monetary policy generally is to promote price stability in the economy, ensuring full employment and supporting long-run sustainable economic growth. And when we talk about expansionary monetary policy, you'll say that expansionary monetary policy basically aims to, increase the level of aggregate demand and spending in the economy in order to stimulate growth, combat recessions, and achieve, a low rate of unemployment. That's what the expansionary monetary policy typically aims, right? And the measures of expansionary monetary policy would, or the monetary policy would typically involve, increasing the money supply that would subsequently reduce the general interest rates in the economy. And also, the central banks at times could take measures such as devaluation, that is, devaluing the exchange rate in order to achieve certain macroeconomic indicators. Since devaluation of the exchange rate is done by the central bank, that is why it is also part of the monetary policy. Then the next step would be that you go on defining what deflation is once you have defined what monetary policy is and when it is implemented in the first introductory paragraphs of your answer. And you'll say that deflation basically refers to a sustained decline or decrease in a general price level in the economy. While obviously deflation might initially seem beneficial for consumers because their purchasing power is going up, but deflation is not it is not beneficial for the economy, especially if it's a bad deflation, because it can have long run detrimental effects to the economy. And when central banks intervene to cure the economy out of recession or combat recessions, one of the reasons, it is basically, and since the question is also asking you to how would expansionary policy, correct deflation, is because the reason is that deflation is primarily a symptom or a side effect of a recession. It shows that the economy, it's simply a symptom that your economy is going through or undergoing a recession, and that is why a central bank and the monetary authorities intervene in order to correct deflation, because the objective is to correct the recession. When you correct the recession, automatically deflation, that is the falling general price level to an extent that it becomes detrimental to the economy, would automatically vanish away, or it would cure itself. And the central bank, through its tools of monetary policy, by making changes to the money supply that subsequently, impacts interest rates in the economy, through, impacting interest rates because of via the changes in the interest rates in the economy, attempts to bring the economy out of recession and combat recessions, and correct the deflationary spirals the economy might be going through, or the deflationary effects the economy might be going through. Because these deflations are, like I said, they are signs of recessions. It's showing that your economy is undergoing recession, and recession itself is something that has negative consequences on the economy. You'll also need to define what a recession is, and recessions are typically a persistent decline in your real GDP for a consistent or a consecutive period of 6 months or 2 consecutive quarters. It's a decline in economic output. It's an economic downturn for a consecutive period of 2 successive quarters or 6 months, right? And so the reason why deflation is so bad for the economy is that it completely reduces the business confidence and the investment in the economy. Your investment level goes down, your business confidence goes down, right? That subsequently results in a decline in production levels, which ultimately causes job losses in the economy in the form of, and that manifests itself in the form of cyclical demand deficit unemployment in the economy, leading to major economic contractions and economic slowdowns in the economy magnifying into subsequent recession. And when the central bank is intervening and trying to correct those deflationary spirals and deflations, it means that the deflation is really bad right now, because that is why, because temporary, if the deflation is quite temporary, so probably the central bank might not intervene to bring about such drastic monetary changes in the economy. But if the central bank is making changes to monetary policy, it means that deflation, you could argue that deflation has quite worsened itself, and that is why the central bank needs to now take action, right? And you can, so another diagram that I would recommend you to draw is that when you want to explain how bad the deflation is going in the economy, is to draw the Keynesian aggregate supply curve, because this curve could, this curve is very good in showing, this diagram is very good in showing negative output gaps and deflations in the economy, or recessions in the economy. And you could say that, so you draw this diagram neatly and properly, and you say that, figure 1 is showing that the economy is right now the economy is GDP is at Y1, right? Just a second. The economy's GDP is at Y1, while the full employment level of GDP is YFE. So it shows that your economy is going through a negative output gap. This is your negative output gap. Negative output gap means that your real GDP falls short of full employment level of GDP. It represents the gap in your output and real GDP and national income, by which the economy is below full employment and below potential GDP, right? So by this much, your GDP has to go up to achieve full employment. That is your negative output gap. And this is obviously this is also signifying that your economy has a lot of spare capacity, since your economy is away from the full employment level of output, right? And the further away it is, the higher the recession, because it creates spare capacity in the economy, it creates slack in the economy, and this slack is a sign that your economy is going through cyclical demand deficit unemployment. And that is why the central bank has to intervene and come up with an expansionary monetary policy to cure deflation. And the objective, when you say that you want to cure deflation, it is a recession that you actually want to cure, right? And so another thing that you could mention over here is that, for the good students who are aiming for the highest possible A stars in the exam, they could also say, otherwise you could also live without writing this line, but for those students who are aiming for that highest possible grades, they could say that, John Maynard Keynes, he believed that, these recessions, they would create spare capacity, and your economy could be stuck in a recession for a long period of time. And hence that requires a government to immediately intervene to stimulate aggregate demand. And one of the ways is, although he proposed expansionary fiscal policies, but since the question is talking about monetary policy, so you could say that Keynes was major proponent of the government to intervene and come up with expansionary policies. And one of the ways is by the intervention of the central bank through expansionary monetary policy. Then, guys, the next step would be that you basically go on explaining that how monetary policy could be effective in curing deflations. So you will need to explain by proceeding that how the expansionary monetary policy, also known as the loose monetary policy or easy monetary policy, will correct the deflation. And basically here you need to explain the mechanism or the process or the initiating process that the monetary policy will trigger, the expansionary monetary policy will trigger or will generate, or through various channels across the macroeconomy that will actually help, which will then actually help to correct and reduce the recession. That is, in simple words, the mechanism of the monetary policy, how that mechanism of that monetary policy works, and what channels it targets across the wider economy. Because when expansionary monetary policy is implemented, that is when the central bank implements changes in money supply, that is, it increases the money supply so that interest rates in the wider economy go down. The fall in interest rates targets your macroeconomy, basically. It increases GDP and everything through various channels, which are also known as the transmission mechanism of the monetary policy. That is, your expansionary monetary policy works through various transmission mechanisms. That is a chain of analysis that you need to establish between interest rates being lowered and your AD going up is via the transmission mechanism or the monetary policy transmission mechanism. And so the expansionary monetary policy would basically cure your recessions, and ultimately you will see it's the recession that the central bank or the monetary authorities are concerned about, that we need to correct, because although the question mentions that it needs to correct deflation, what it actually means it is that it needs to correct the recession actually, because it is a recession that we are basically trying to cure here. Because deflation is just a symptom of recession, or one of the ways through which recession is manifesting itself. So expansionary monetary policy, whose objective would be to somehow increase the money supply so that it has an impact on the interest rates in the economy, they go down. That's how the monetary policy would reduce interest, because increasing money supply would cause your interest rates in the wider economy to go down, right? That's how monetary policy would reduce the interest rates. And the primary objective of ensuring that your money supply goes up and your interest rates goes down across your wider economy, like all sorts of interest rates, like interest rates on mortgages, car financing, house loans, personal loans, educational loans, right? So all sorts of interest rates goes down. That is the objective. That is the objective of monetary policy, to target interest rates across the wider economy, and it does this through making various channels and making various changes in your money supply, right? And um, and hence the primary objective of monetary policy is to combat economic stagnancy or economic slowdown or a recession. And by reducing interest rates, it will encourage spending by consumers and businesses in the economy. And so what you need to then do is that you need to make another diagram, and you show and so you will make a diagram where you will show that your economy was initially at E1. Right now your economy was at E1, where your aggregate demand was very, very low, right? It was very low than what it should be, and what it should be is 82, and your price level was very low at P1, and real GDP was very low at Y1, which was below full employment level of GDP. And so you had a negative output gap here, or a recessionary gap here. So with the successful monetary policy implementation by the central bank, it will help in increasing increase spending in the economy, and that causes the aggregate demand to go up and shift to 82, right, from 81, as you can see in the diagram. So this increases our real GDP from Y1 to YFE back to full employment. So you can assume that. I mean, you could also say that your AD could shift, and you could make that shift up till here and still keep some level of a negative output gap still remaining. But then ideally just represent an ideal scenario, because it's just saying correcting the deflation. So an ideal scenario could be that you show that your economy moves to YFE, although that would be correct as well. So this increases our real GDP back to full employment level of GDP, hence eliminating the negative output gap. So your GDP now is where it actually should be. That's the ideal scenario. That's your long run equilibrium at YFE. That is showing that your GDP is at its potential GDP. So your GDP now is where it should ideally be at YFE. So our actual GDP is at its potential, and price level has gone up to P2. Right, price level just went up to P2, and you see that P2 over here basically, although the price level has gone up, but P2 you also you have some level of inflation, demand pull inflation coming up, but this P2 is more desirable than P1, because this P2 is healthy and desirable for the economy, as P1 was shockingly and absurdly low price level, because it was showing a price level which was very low, indicative of a recession. P1 was showing that an economy was deflating itself, that is bad deflation, while P2 shows inflation that is desirable, and economy, because the economy reaches its potential GDP and exhausts all its capacity. So it is where the economy should ideally be in the long run, at YFE. Hence at YFE, the price level P2, at YFE and with the price level of P2, what you'll end up saying is that the monetary policy has been successful in correcting the deflation. That's how you explain the diagram. So obviously, while I'm recording this video, I'm just giving a lot of details for you to have a bit of understanding as well. But when you'll end up writing in the exam, so probably the explanation would not be too significant as it was right now. But at least you need to mention the basic points, that your economy moves from Y1 to YFE, the price level goes up, which is sort of healthy and desirable, and your AD goes up, and the reason why AD goes up as well. So now I'm going to be discussing why is AD going up, as in why is consumer spending rising, because what are the reasons that causes your consumer spending to go up because of an increasing money supply and reducing interest rates, how does recessions and bad deflations end, right? So guys, now the next step would be that we need to explain how would basically aggregate demand go up and how that would help curing deflation. So basically, the reason for correction in for deflations and recessions to end is that your aggregate demand is going up because you have made sure, the central bank has made sure that it stimulates aggregate demand through an expansionary monetary policy. So you need to show or explain or analyze that how does an expansionary monetary policy helps in boosting your aggregate demand and then combating a bad deflation in the economy or a recession in the economy. And so what you'll say is that, because of a fall in your interest rates in the economy, cost of borrowing goes down. So, and when the cost of borrowing goes down, basically it will make it cheaper for consumers to borrow, which reduces the opportunity cost of borrowing, right? Because interest rates is basically an opportunity cost for borrowing money, right? And the opportunity cost of borrowing goes down, and as a result, when consumers end up borrowing, they can actually borrow more now, and which allows them to spend more on items such as houses, cars, and furniture, which increases consumption, and consumption in the AD equation, C goes up in the AD equation. That's why AD moves from AD1 to AD2, as you can see in the diagram as well, right? Secondly, the cut in the interest rates is also a cost of borrowing for the firms as well. And since the cost of borrowing for firms goes down, firms find it more feasible to borrow more because now, for them, borrowing is now more profitable because since they have to pay less interest on the sums of money that they're borrowing, right? And so firms would also borrow more money and they would invest more in expansion of businesses, on machinery, plant, equipment, on buildings, right, on factory expansion, and that would cause investment in the economy to go up, right? So basically this is going to cause C to go up while this is going to cause I to go up, both of which are part of the AD equation. So AD goes up because of that, right? So this is something that you need to mention. Secondly, what happens is that when interest rates in the economy goes down, interest rates not only represent cost of borrowing but also a return on savings as well. For people who save money in order to earn interest, and for them it's a return on saving. So that reduces the return to save. And when the return on saving goes down for savers and people who deposit money in banks and earn interest on it, so this reduces the incentive to save, and instead it increases the incentive to spend or borrow money to spend, basically. So people save less then and borrow more and spend more, because now the opportunity cost of saving money is quite high because they aren't really getting a lot of interest on it, so the returns are low, and instead they could spend that money and probably end up having a higher utility. So that's why we're saying that the opportunity cost of saving now is quite high. So as a result, people will end up saving low. The saving ratio in the economy would go down with more consumer spending instead of saving taking place, right? So consumer spending would increase, again consumption goes up in the AD equations. So there are two reasons why consumption is going up. One reason is that borrowers find it cheaper to borrow, and secondly, a lot of those people who were saving their money will now also prefer to borrow more and spend more rather than save more, right? And thirdly, there's another channel through which your consumption would go up, and that is when people, a lot of times when people have taken mortgages are basically your house loans. So at times they have variable rates of mortgages, right? And so a cut in interest rates will reduce the monthly payments for those who are on variable rates of mortgages. So as a result, when they have to pay less interest rates now on their existing loans, because they had a variable mortgage rate, so these homeowners who had taken loans to buy up houses will receive a boost to their disposable incomes, because now they'll feel they have more incomes as they are paying less interest compared to last month, and so they have more money left with them at their disposal, and hence they could end up spending that money. So as a result, it will boost consumption spending in the economy, so they will also end up spending more. So C again in the AD equation is rising. So when you're saying that an expansionary monetary policy would increase consumption expenditure, you need to tell the channels through which consumption expenditure is rising. And that is basically part of your analysis. And that's how you tell the examiner that, okay, fine, you know the complete chain of analysis. All right? And that is exactly what differs an O-level student from an AS student. An O-level student also studies monetary policy in the exam, and he would also end up writing that, expansionary monetary policy increases AAD. But the difference lies in the way an AS student will approach the answer, right? So another very important thing that I want to discuss is that, there's another channel through which your expansionary monetary policy works, and that is, for example, what would happen is that if interest rates would go down in the economy, for example, interest rates in the UK go down, let's say. So let's assume this is the UK economy, and if interest rates in the UK go down, so what happens is that there are a lot of financial investors who who deposit their money in other countries from abroad or the rest of the world. So they might have deposited their money in UK, banks, because UK was offering a high interest rate, right? So it's the relative interest rates that these financial investors take into consideration. So let's suppose if the interest rates in UK are relatively higher as compared to the rest of the world, then financial investors from the rest of the world would deposit their money in UK to earn a higher rate of interest and get a higher return. But if interest rates in the UK economy go down, and if relatively they are going down as well, right? If they're going down and in relative terms also they go down, investors will then move their money out of the UK financial institutions in order to chase better interest rates elsewhere in the world. And what this implies is that this would basically result into hot money outflows, right? It would result into hot money outflows. And hot money outflows, what this will do is, it will increase the supply of pound from the UK economy. Because when people would withdraw their money out of the financial institutions, right, they would convert the pounds into their own currencies, right? So this will actually increase the supply of pounds in the foreign exchange market, and when the supply of pounds go up, it will weaken the exchange rate, right? So it will depreciate the exchange rate or weaken the exchange rate. So weak exchange, and we know economic theory tells us that when the exchange rate weakens, a weak exchange rate would make your exports cheaper because the price of exports would go down, and a weak exchange rate makes import expensive or imports dearer, right? That is, the price of imports go up, and and what will happen is that the price of exports would go down and the price of imports would go up. So the demand for imports and therefore the expenditure on imports will decrease. So your demand for imports will go down and your import expenditure would go down, right? While on the other hand, the demand for exports and therefore the export revenue will increase. The demand for exports will go up and hence the export revenue will go up. So the final thing that's happening over here is that export revenue is going up while import expenditure is going down. And export revenue going up and import expenditure going down basically means net exports going up. That is X minus M. The X minus M in the AD equation stands for net exports, right? So it's X is export revenue minus M is import expenditure. So your net export expenditure is basically going up in the AD equation. One effect that this would cause is that it would improve your current account deficits and reduce your current account deficits and improve your basically balance of trade position on your current account. At the same time, since net exports is a component of AD, so your aggregate demand will go up as well. So you see, the reason why AD has shifted to the right and why deflations and recessions have ended is not only due to the fact that C, consumption expenditure, has improved or increased. And an A-level examiner would definitely be expecting you to mention that why is C going up or I going up, or your exports going up. How is AD going up? And so a lot of times it has been observed that students end up writing in the exams and they end up, not getting the desired grades because they don't write it in the way it is expected. And this is what is expected from you, right? You need to be elaborative and your chain of analysis should be very clear. You need to know this, that if expansionary monetary policy is implemented, then why is AD going up, right? So just writing that cost of borrowing will go down is not what the examiner is expecting from an A-level student, right? So yes, expansionary monetary policy will help the economy end deflation or a period of deflation, which is a recession actually, through a rise in aggregate demand, bringing your economy back at full employment, increasing your real GDP, causing actual growth to go up in the economy, causing economic growth in the economy. At the same time, very importantly, that you need to mention that your cyclical unemployment, that is your demand deficit unemployment, will go down as well, as people would end up finding more jobs because they were initially jobless because of a deflation, that is a recession in the economy. And now, as economic activity expands and economy is recovering from a recession because of expansionary policies, and as economic expansion takes place and growth goes up, firms end up hiring more workers as demand for goods and services rise across the wider economy. Right? Now, guys, our next step would be to proceed towards evaluation, that is your assessment objective 3. And now we're going to be evaluating whether an expansionary monetary policy is effective in reality in reducing deflations. And when we talk about evaluation in economics, it primarily involves two things. It involves you critiquing the argument or the narrative. For example, if the narrative is that yes, or the assertion is, let's say, if you're asserting in the exam that a monetary policy is effective, then critiquing that assertion would tell about the factors or the reasons why a monetary policy may not be that effective in curing or combating bad deflations. And so that's one aspect of evaluation, and the other and during the process of critiquing the narrative or critiquing the assertion, evaluation, you would be assessing the strengths and weaknesses of the monetary policy as well. Weaknesses not in the context of weakness of a monetary policy in general, but weakness where the monetary policy will fail to actually address deflation in that context, basically. So you need to tell the overall effectiveness of monetary policy and when could possibly monetary policy fail. And so that's what evaluation is for this question. And you will say that, the effectiveness of monetary policy. And then the second aspect of evaluation would involve when you say that the effectiveness of monetary policy would depend upon, these and these and these and these factors. So the factors that would determine how effective monetary policy would actually be in combating a recession or, deflation is something that would, comprise of evaluation for this question, that is your assessment objective 3, right? So guys, now if you're evaluating this basically question, then a few points that you could write in the exam is, as far as the evaluation is concerned, that you could say that the effectiveness of monetary policy in correcting deflation would depend upon the initial level of economic activity. And what we mean over here is that monetary policy would be successful in basically curing a deflation, especially if you have a lot of spare capacity in the economy. So for example, let's say that this is your aggregate supply curve. So for instance, if the level of aggregate demand in the economy is somewhere over here, and your GDP is quite below from the full employment level of GDP, then policymakers have a lot of room right now to play with, to play around with aggregate spending in the economy so that they could push AD or stimulate AD to increase or to close this negative output gap. So you basically have a lot of room right now in this area to play around, and policymakers could keep on increasing aggregate demand and stimulating aggregate demand to a point that full employment is reached and the recessions end, and so does deflation is corrected, right? And guys, so let's say if your economy is close to full employment somewhere in this region, then somewhere in this area basically. So what happens really is that over here, even if you're trying to increase aggregate demand to stimulate AD to sort of correct the recession and reduce deflationary impacts, then basically here, like I said at the start of the video as well, when you're trying to correct a deflation, you're actually correcting the recessionary effects, right? And then basically expand the economy and promote growth, right? So in this case, you have a lot less room to play around with policy making, because you see your economy is already very close to full employment, right? So in this case, you're already very close to potential. So an expansionary policy on this stage would be less effective. Although you can actually argue that probably your economy will not be at this stage in the first instance, because you already have a very bad recession accompanied with bad deflation, so you might already be well below full employment, right? Now, the second point that you could mention is that you could talk about how effective expansionary policy could be in correcting a deflation depends upon the magnitude or the scale of the interest rate reductions. So if the interest rate cuts are large, then it will substantially reduce the cost of borrowing and therefore more likely to incentivize consumers and firms to borrow money for consumption and investment purposes, causing large rise in aggregate demand. Also you could say that, like I said, because the exchange rate depreciates, because interest rate goes down, the exchange rate goes down as well. Depreciation in exchange rate because of hot money outflows. So if there's a large decline in interest rates, then it might worry financial investors and they might withdraw their capital and result in hot money outflows, and exchange rate will most likely depreciate by a greater margin, hence increasing net exports by a large amount. So overall, your aggregate spending goes up, your economy expands, and hence your deflation is more likely to be, if not entirely 100% corrected, then at least a major substantial correction would be witnessed by the macroeconomy, right? Also, you could talk about the fact that, and this is something that Keynes was, really focused on, the third point, that even though expansionary policies are effective in correcting recession or a bad deflation, but it actually depends upon the level of consumer and business confidence. And in the past we have experienced certain years where demand side policies have failed to address recessions and bad deflations, because already the level of consumer and business confidence is so low. So if the consumer and business confidence is very, very low, a reduction in interest rates, regardless of the size of the cut, may have little impact in stimulating aggregate demand, as consumers may be mindful of their future employment prospects, and they might be looking at the economy from a very gloomy or pessimistic stance, and they might be foreseeing unemployment in future, right? So consumers may be cautious against redundancies and job losses and may be more inclined to save money rather than spend money. So even if you're cutting the interest rates, businesses and consumers might not spend. They might be unwilling to borrow and unwilling to spend, hence, on investment projects and consumer spending. So aggregate demand is unlikely to increase, if at all, leaving your macroeconomic objectives unaltered. So in this case, you could argue that, an expansionary monetary policy will not correct your deflation, right? So this is a very important point, especially this point is extremely important, and especially this point as well. And time lags point is also very important as well, right? So this is what evaluation is, and that is how you evaluate, right, in your answer. You could also say that the effectiveness of monetary policy would depend upon, time lags, as in the length of the time. I mean, you don't really need to mention, you need to say that it depends upon the length of the time lags for interest rates, that is a monetary policy, to actually have an effect on your wider economy. Because you see, the thing is that if you're trying to correct a deflation, then the question says discuss whether expansionary monetary policy will correct your deflation. That's what the question says. Will be successful in correcting deflation. So here you could say that expansionary monetary policy alone will not be successful in correcting deflation. The reason being that you could talk about the length of the time lags, because you see, it's widely accepted fact among economists and policy makers that when you reduce the interest rates, it takes at least 2 years to have full impact on the wider economy. So if your interest rates go down, and so we already talked about how it takes time for the interest rates to fully feed through the transmission mechanism of the monetary policy by affecting different channels across the aggregate economy before it has an impact on aggregate spending and demand. So it takes time for your interest rates to actually have an effect on the wider economy to feed through the transmission mechanism of monetary policy. Also, it takes time for consumers, firms, and foreign financial investors to react to changes to interest rates. Therefore, you can't really expect an immediate reaction or an immediate increase in aggregate demand and an immediate correction in the short term to medium term for deflation, right? So hence, completely relying on monetary policy to correct a deflation might not be a rational move, or right, by the policymakers. So you could write this, okay? And that is where a good student and the best students' answers are differentiated, or A star answers are differentiated, or distinction answers are differentiated from average or a good answer. That an average or a good answer would just mention about there are time lags involved and it takes time for the monetary policy to take effect, while the best answers would say that Although yes, it takes time for monetary policy to have an effect on the wider economy because of the various channels it has to impact, and it takes time for consumers and firms to realize. But then at the same time, this also, and so how is this important to us? It is important to us because we realize from this, okay, fine, if it is taking time, then we don't need to just rely on monetary policy then, right? Maybe fiscal policy and supply side policies might need to be used as well. Okay. So this is your evaluation and assessment objective 3. And now the next part for this question would be the judgment or your final conclusion paragraph. So guys, the conclusion would involve you saying that, or to conclude. So basically, first of all, the way you start your conclusion is that you just write off by saying, to conclude, or in conclusion, this and that. But don't say, in my opinion, or I think that, or neither do you end up saying that, yes, in my opinion, expansionary monetary policy will correct deflation. Because here they're not asking you to sort of directly make a statement whether you agree with this or not. So I agree with this, or I agree with that, or I do not agree. Do not take this stance. Instead, what you will say is that, in conclusion, expansionary monetary policy is definitely a powerful tool in correcting deflation or combating deflation. But then mention that it's not the only tool and it has its limitations. So in conclusion, this is how you write a conclusion. So you'll say that its success depends on various circumstances and factors as outlined above, that we mentioned in the evaluation that it depends on, right? Although yes, expansionary monetary policy does reduce and mitigate the deflationary pressures, its effectiveness may be limited by certain factors, such as, for instance, by counterproductive policies by the government, such as contractionary fiscal policy, right? So what if the government implements a contractionary fiscal policy at the same time, right? So the effect of expansionary monetary policy might be offset by a contractionary fiscal policy. So you'll say that its effectiveness may be limited due to a contractionary fiscal policy being implemented, or the fact that the level of consumer and business confidence in the economy is extremely low, right? Such that the stimulating aggregate demand via expansionary monetary policy and reduction in interest rates is not really working for the economy, right? So you'll end up saying that, therefore, while expansionary monetary policy does and can play a role in correcting deflation, so that, right? So it's like, you speak in a normative language. It does and can play, in correcting a role in correcting deflation. At the same time, you mention other policies that might be used to corroborate expansionary monetary policy and give expansionary monetary policy probably a boost, right? So both policies could reinforce each other. So for example, you'll say that it needs to be complemented by other policies, such as expansionary fiscal policy and expansionary supply side policies as well, right? To help the economic recovery to be not only to help the economic recovery to be lasting and sustainable, right? So the economic recovery from deflation and a recession is not only lasting, but it's sustainable as well, right? So that's how you sort of conclude your answers, instead of just saying that, yes, I think expansionary monetary policy would correct a deflation. And that is exactly the language that students who end up getting A stars, or the distinctions, or the best students end up writing. So I hope this video really helped you. If it did, then I would love to hear your views and your feedback and your comments as well. I'll see you probably in some another video some other time. Until then, take care.